This is Jody Trana with Chapter 10, Part 2 of Business Finance. First of all, let's review our valuation that we've been practicing. We, in Chapter 9, practiced valuing bonds. You'll remember that the value of a bond is based on its future cash flow streams discounted back to the present value. We discount it back based on the market's required yield to maturity. That's what the market is demanding as far as an interest rate for bonds. After bonds, we talked about valuing common stock. We know of common stock as an investment that can grow in value as the company's profits grow. But we are primarily looking at common stock and its value based on the expected dividends that come back to us. It's based on the financial principle of cash flows are the source of value. We will be looking at the expected dividends, and we will determine the present value of those dividends based on the investor's required rate of return. We look at common stock as a growing perpetuity. A perpetuity does not end, and the growing aspect lets us know that this is expected to grow in value. Dividends are expected to go up based on the increased profitability of a company. That's how we'll determine the value of common stock. And this presentation zeroes in on valuation of preferred stock. The main difference between common stock and preferred stock from an investing standpoint is that preferred stock has promised dividends, where common stock you just expect to receive dividends, but it is in no way any type of agreement that you will. With preferred stock, there is a known dividend that you're expecting. To calculate the valuation of a preferred stock, we would look at the present value of a level perpetuity. That's one that does not grow in value. So let's review the differences between preferred stock and common stock. First of all, preferred stock has a fixed and known dividend, where common stock, the dividend is not known from year to year. With most preferred stock, there's a cumulative feature on the dividends, whereas if there's a tough year or two, those dividends are still expected to be paid, but may be paid in the future. Preferred stockholders do have some claims on the assets and the net income based on their ownership. And with preferred stock, there's no fixed maturity date, although preferred stock can be retired periodically. Let's review perpetuities. Remember that an annuity is a regularly scheduled and even payment amount. A perpetuity is an annuity, but it is called a perpetuity because it continues forever. Most annuities have a maturity date, but not a perpetuity. A dividend stream on stock is expected to continue forever, so we consider it a perpetuity. There are two kinds of perpetuities. A level perpetuity, that is one in which the payments are constant and do not change. We would expect preferred stock to pay a level perpetuity. And there's also growing perpetuities. That's a perpetuity in which cash flow grows at a constant rate from period to period. We would consider a common stock dividend payment a growing perpetuity. Calculating the present value of a level perpetuity is about the easiest equation that we have in business finance. All you do is you take one payment amount and divide it by the interest or the discount rate that you're using. That's the value. To calculate the present value of a growing perpetuity, it's very much the same, except you take that interest or the discount rate and you subtract from it the growth rate. So let's translate this information into a valuation of preferred stock exercise. Preferred stocks are perpetuities. They go on forever. They do not mature. So the present value can be calculated by doing the perpetuity equation. You'll remember that that's the dividend divided by the interest, or in this case, the market's required yield on preferred stock. So the investors desire a certain yield, and that's the yield we want to use as our discount rate. Let's put some numbers to it. What is the value of preferred stock that pays $12 in dividends and the market's required yield is 8%? We can put that on a timeline to show our $12 level perpetuity. We can also show our investors' required rate of return, or the market's required yield of 8%. The value is easy to calculate. You take your annual preferred stock dividend of $12 and divide it by the market's required yield, that was 8%, and you get your value of preferred stock of $150. Let's take it another step further. With Kenra Corporation, their preferred shares are trading for $30 in the market, and they pay a $4.50 annual dividend. Let's say that the market's required yield is 14%. Here are some of the questions we ask ourselves as we're evaluating this stock. What is the stock's value to me, the investor? Should I purchase the stock? And what would be the added return if we purchased it at $30? Let's take a look. We can calculate the stock's value by taking the dividend, $4.50, divided by the market's required rate of yield, which is 14%. $4.50 divided by 14% is $32.14. What that tells me is that the value to me, because I require 14%, is $32.14, which actually is greater than the price. Should I purchase the stock? Absolutely. I'm going to be getting more value from it than the price of it. This stock will return an additional 7.13% because the market yield that we require yields us more money than the actual price of the stock. This is a good deal for us.